Trends are fast, directional, and tend to go farther than what traders expect. The US dollar yen has been trending. Looking at the daily chart, the price bottomed in mid to late January near the 113.42 level and reached a high today of 143.068. That is nearly 3,000 pips to the upside in less than 8 months. Since August 2nd, when the pair based against the 100-day moving average, the price is up 1,271 pips in 25 trading days. Today, the pair has a range of 283 pips, well above the 136 pip average over the last 22 trading days. That's around a month of trading. How have you done in this trending market? When I was at FXDD, I got to see firsthand how traders did in trending markets. We all know that the trend is your friend, but it is during trending markets that traders, especially retail traders, tend to fare the worst. The reason is trends are fast, directional, and tend to go farther than what traders expect. That is good news if you are on the trend, but horrible news if you trade against the trend. Instead of taking advantage of the fast, directional, and farther dynamics, all those things lead to big losses. So why do traders not do well in trends? For one, they lack the firepower to trend the market. Retail meme stock traders may be able to combine forces to trend a meme stock, but they don't have the power to trend a currency pair. The larger traders in Forex can, especially if they all get on the same page with the same idea. As a result, retail traders need to often jump on the trend when it starts and continues to trend, which leads to reason 2 why retail traders don't trade trends well. And that reason is retail traders tend to buy low and sell high reasonably well. As a result, they may get on a trend, but they get off the trend well before the fast directional and go farther than traders expect is up. In fact, they tend to go against the trend because they cover their initial position for a small profit, and then as the market continues to trend higher, like the dollar versus yen, they sell again. And that's way too early, going against the trend. When the price continues to trend, they compound the problem by doing yet another anti-trend position by adding to their position instead of cutting out with a loss or even covering and going with the trend. Eventually they get stopped out as the fear of failure catches up to them and the market starts to capitulate. They're the ones capitulating. The end result is the dollar yen moves up near 3,000 pips. But not only did the traders lose a boatload of money, but they also missed the trend where they had the chance to make the most amount of money with the least amount of risk. All they had to do was recognize the bullish bias and hop on some of the trends. So how do you get on a trend? One way is by measuring the corrections using Fibonacci retracements. Let me show you. Looking at the dollar versus yen, this is the daily chart of the dollar versus yen. And as you can see, when we started the year, the price was near the lows, for a matter of fact, for the year. The market initially moved down, but really in January and February and into March, the price was non-trending in a very narrow trading range. I want you to recognize here the 100-day moving average and how the price bottomed against that moving average level through here. That was the base that started the move to the upside. Remember, that was the base. Now, when the market started to trend through here, it was fast, directional, and tend to move farther than what traders expect. Certainly more than these ranges, wasn't it? And if you were able to put a Fibonacci from this low to this high right here, where the market eventually peaked right on this trend move, and measured the Fibonacci retracement, it came down and tested the 38.2% retracement. In a trending market, you will see trend-like moves, corrections down to what I call the correction zone in between the 38 to 50% retracement, and then look for buyers in this level. If you find buyers against this level and the price starts to move higher like it did through here, it's often a signal that we're going higher, and that's exactly what the market did. So now let's take the next leg to the upside. That goes from this low right here, remember our corrective low of the first trend move, and then we start this other trend move to the upside. And note the correction through here. The market took, a good 3 or so weeks of downside movement here of this trend move, but where did we find support? Right in between the 38.2 and 50%. In fact, the market came down to the 50% retracement level and stalled against that level. Buyers were leaning against that level. The trend was still to the upside. That was a clue for traders to get in on the trend. So what do we see next? Well, if we take this move to the upside here and move from this low right here to this high right here, where do we correct down to? Right in between the 38.2 and 50% retracement. Is the trend still alive? Yes. Moreover than that, we found support against these old highs through here. So there's a couple reasons why buyers came in here and they pushed the market further to the upside. That last move to the upside took the price all the way up from this low right here at 126 to 139. And now we start to see a little bit more of a corrective move to the downside. Why? Well, we broke through this trend line. That was more bearish. We got through the 38.2. That was more bearish. And we got through the 50% retracement as well. But note where we went to. We went below the 61.8, and where did we stall? The 100-day moving average. When we went back here, what started the trend? The 100-day moving average. So notice the symmetry here in buying against that dip, and we saw the buyers re-enter the market through here. Now we are on our last trend move to the upside, or our current trend move to the upside. I'm not going to call it the last because we don't know if this is the last. But what we saw on the move to the upside here and the correction move down here was that the market was still unsure about whether we're going to continue this fast directional move to the upside and greater than what traders expect move to the upside. And so there was some apprehension, and we did see the market rotate back to the downside here. But once we held above the swing highs right here, the swing low right here, and also the 100-day moving average, it was off to the races, and we've seen the price really move up a number of days here with just a few corrective days along the way to the downside. This is the next big move to the upside. Is it capitulation on the top side? I'm not sure, folks. I really can't call a top right now. We got above the underside of the broken trend line here, moved up to 143.068. It seems like the market still has momentum. What would kill the trend? Well, if we have our Fibonacci retracement of this move to the upside, the 38.2, the 50% retracement comes between 136.72 and 138.22. Moves below those levels would help to kill the levels, the trend move, maybe call the top in this currency pair. But until that happens, folks, the trend is still your friend, and you have to think in terms of buying the dip or getting on the trend. Levels to get on the trend might be against this trend, the broken trend line here. We will see. It's there are other techniques that you can follow when I do the analysis on forexlive.com. But that's the idea, folks. So trends are fast, directional, and tend to go further than traders expect. Remember that. Remember that, and don't be like the other retail traders and miss the trend entirely. Get on the trends when you start to see them. My name is Greg Michalowski. I hope you like this video. If you did, give it a thumbs up. If you didn't, give it a thumbs down. Also, be sure to follow our YouTube channel. Put comments in. Hearing from you is most important to all of us. So please consider that. Good fortune with your trading. Bye-bye now.